year, the economy has been a major subject of discussion. It's understandable that people are concerned about the direction the economy is taking. With prices rising everywhere and interest rates rising steadily, with a 21% drop on June 13th, the S&P 500 entered a bear market. And since we're talking about the economy, you might have heard the terms bull market and bear market. These two expressions are so universal that even those who use them do not know what they mean. That's why it is better to take a more in-depth look at these two different kinds of markets and the role that each plays in your overall investment strategy. Welcome to Money Talk, where we discuss tips on making money. And in this video, we are going to learn about the bull and bear markets and how they will affect you and your investing and financial decisions. But before we begin, don't forget to hit that like button, hit subscribe, and click that notification bell to receive updates and be the first to check out our latest videos. Now, let's begin. Starting with the bull market. A bull market is when the prices of investments keep going over a long period of time, at least 20% from the most recent low point. Bull markets tend to happen when the economy is strong, the gross domestic product (GDP) is high, and the unemployment rate is low. Public opinion is often favorable during bull markets, and investors are ready to acquire and hold investments because they believe their value will increase. A trend like this is based on the stability of investments to come and the general confidence in the economy. It is easier for people to spend more money on goods and services when the economy is doing well, and there is less unemployment. Investor sentiment has a huge impact on whether the market rises or falls because of how people see the economy. Now, what is a bear market? The market has entered bear market territory when the prices of investments go down for a long time, usually 20% or more. As the prices of investments keep going down, investors' confidence drops and a negative mood grows, which drives down the value of securities. Bear markets, in contrast to bull markets, are frequently accompanied by a sluggish economy and increased unemployment rates. Bear markets can be caused by global events like a pandemic, and they tend to happen at the same time as bull markets, which is different from bull markets. It is not uncommon for people to get a bear market and an economic recession confused with one another. Despite the fact that the two frequently go hand in hand, each is associated with a distinct set of problems. A bear market refers to a decrease in the stock market that is driven by negative investor mood, which is frequently brought on by fear or uncertainty. On the other hand, an economic recession is characterized by a general slowdown in economic activity as well as a significant decline in GDP. Bear markets can happen at any time and without notice, which makes it easier for investors to be caught off guard. Even though it's hard to say when the next bear market will start and how long it will last, history shows that bear markets do happen and are pretty normal when it comes to investments. Because bull and bear markets are difficult to forecast, investors can often only detect the occurrence after it has already occurred. So, these different market conditions are labeled after the fact instead before they happen. What are the key differences between bull and bear markets? Changes in the unemployment rate. When the market is going up, the unemployment rate goes down. When the market is going down, the unemployment rate goes up. Throughout bull markets, businesses grow and hire more people. But during bear markets, they may have to lay off people. A bear market tends to last longer when the unemployment rate goes up, because fewer people earning wages means less money for many companies. Interest rates currently in effect. Most bull markets are accompanied by low interest rates, while most bear markets are accompanied by high interest rates. Businesses can borrow money and grow more easily when interest rates are low. High interest rates, on the other hand, tend to slow the growth of businesses. Change in GDP. Bull markets happen when GDP goes up, and bear markets happen when GDP goes down. GDP goes up when companies make more money and employees get paid more, which allows people to spend more. GDP goes down when company sales are slow and wages stay the same or go down. Bear markets are often linked to recessions and depressions in the economy. When GDP falls for 2 consecutive quarters, this is called a recession. A depression occurs when the GDP falls by 10% or more and remains low for at least 2 years. The inflation rate. Even if there is a greater likelihood of price inflation occurring during times of economic expansion, it can nevertheless take place during times of economic downturn. When there is a bull market, there may be high demand for items and services, which may drive prices to rise. When there is a bear market, however, there may be a lower demand, which may lead to prices falling. Stock market performance. In a bull market, stock prices go up. In a bear market, they go down. Even when there are short market corrections, the stock market always goes up in value when conditions are bullish. Under bearish conditions, the stock market loses value or stays the same at low prices. How should you invest when the market is up or down? In bull markets, growth stocks tend to do well, while in bear markets, value stocks tend to be better buys. Value stocks tend to be less popular in bull markets because people think that undervalued stocks must be cheap because the economy is doing well. The manner in which you invest in stocks throughout the bull and bear markets mostly depend on your time horizon. If you do not need the funds for decades, the current bullishness or bearishness of the market is of little consequence. As a buy and hold investor, you probably shouldn't change your investment plan based on how the market is doing at the moment. Even when other asset classes are going up, the stock market can still go down, and vice versa. If the stock market is going up and you're worried about rising prices, it might be a good idea to put some of your money into gold or real estate. If the stock market is down, you might want to increase the number of bonds in your portfolio, or even turn some of them into cash. You can also spread your investments around the world to take advantage of bull markets in other parts of the world. No matter how the stock market is doing right now, it's important to keep your eye on the long-term prospects of businesses in which you have invested. Companies with strong business fundamentals are likely to make you a lot of money in the long run. It is essential for any type of investor to have a firm grasp on the concept that a bull market indicates rising stock prices and a healthy economy, whereas a bear market indicates decreasing stock prices and maybe a feeble economy. Keep in mind that maintaining your current investing strategy is typically the smartest thing you can do with your money while a bear market is occurring. Even though it is easier to feel confident about your investments when the market is bullish. If you enjoyed this video, make sure to hit that thumbs up button, click subscribe, and hit the notification bell to receive updates on our latest videos. Also, feel free to leave us a comment. If you want to watch more videos, head on over to our channel to see more from Money Talk. See you!